The following is a presentation of TFNN. Live at TFNN, the Power Trading Hour, with your host, David White. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, David White.
And welcome all to another exciting edition of the Power Trading Hour with me, your humble, lovable, squeezably soft host. That's me, Dave White. As we meet each day over most of this TFNN network, we are looking for a market that has maybe some movement or even a little bit of direction. But they're trying to do everything they can to make sure that this market is on the road to nowhere. We're up 2 points on the S&P cash. Was down 11 or 12 or so earlier and up 2 now. And pretty much the exact same thing has happened for the last 2 weeks, which is, with rare occasions, any kind of pullback is bought. As soon as you get to pretty much flat on the day, there's zero volume. And that means that people love to buy the dip. They hate to buy the breakout. And what happens? Can they make a little money by buying the dip? I guess they can. But for the most part, it is somewhat problematic. 1.7 billion shares on the New York Consolidated Tape. And every time we get up here, the volume just falls out. Had some fairly decent volume to the downside. Buyers came in and without a lot of volume, push it back up. And it seems like it's one of those Groundhog Days all over again. Thank you, Bill Murray. Other things are going on. Of course, it is the 28th. This day in 1971, Wells Fargo launches the first stock index fund with $6 million from a pension fund from Samsonite. I remember the gorilla banging on that Samsonite. Anyway, the trader executing the orders for the new fund immediately acquires the sarcastic name Discount Diane. Snipes a mutual fund manager. If people start believing in this random walk garbage and the switched index funds, a lot of $80,000 a year portfolio managers and analysts will be replaced by $16,000 a year computer clerks. Well, what happened was $400,000 a year computer programmers that knew particle physics took over from the $200,000 a year fund manager or more, $400,000. But that's in the last year. But it all started in 1971. It just can't happen, he says. Yeah, it's kind of like movies and then television, radio. Things continue to move and change. A lot of people don't like change. And I'm, for one, I was shocked by change this weekend. I have not been in a Kmart for probably 5 years. And I watch some of these deal sites and always looking for things, especially down in Florida, to add to my war chest if everything goes to hell in a handbasket with a hurricane or other things. But I didn't rush out and buy a $10,000 bug out kit. I just kind of buy things as they come along. So I found these nice water jugs that hold 6 gallons apiece. Normally these things are about $20, but they were $6 on the Kmart website, so I bought 3 of them. And to save $6 a piece in shipping, I just figured when I was out and about this weekend, I'd go pick them up. So I swing on by the Kmart. And I tell you what, I always was kind of amazed by the Walmart I go to and how many people are in there riding the little carts around. This place looked like an orthopedic surgeon's waiting room. I haven't seen so many people that have had problems in my life, but there must be something to Kmart. And since this is not really a bad area, I'm wondering if if Kmart just kind of attracts people that are infirmed or inflamed. In fact, I was standing behind this guy, and I thought it was kind of funny because he had a shirt on that had Tea Party on it with a big slash through it. But he had one leg that looked like it had been run over by a car. And he was in front of me with a cane. So the gal's talking to him, and she can't see past the countertop, so she can't see it. So she goes, well, we're going to need to go over here to take care of it. And she just turns around and starts walking, doesn't even ask to see whether the guy's going to come along or not. So this guy basically hobbles all the way around, probably about 40 feet, just barely makes it. I kind of felt sorry for the guy. But a lot of people in there. Just Florida is God's waiting room to begin with. But I have a feeling this is the whole story made me kind of feel just a little itchy and scratchy, and that everybody in there had some kind of major medical problem. Made me think I was next. But I can see the reasons why people don't think Kmart and Sears are going very far. This Kmart was, 300 yards from a big Sears that I used to go into when I first moved down here in Florida. But it is, that Sears is all turned yellow. It's got the tile that's all turned yellow. It's got the ceiling tile that's all turned yellow from the fluorescent lights always beating on it. It's got rain-soaked holes. I mean, the whole thing makes you think you're going to die from some kind of mold allergy if you go into the places. But I don't know. But eventually, my guess is that it's rather sooner than later they meet the same fate that Radio Shack is staring down in a hole right now. So we'll look at it. Anyway, well, just one thought. On the financial infotainment shows today, Mark Faber's out once again calling for a 30% pullback. And the problem with, we had a call, a week ago Friday, when someone called in and said, how can you be bearish? And the answer normally is because you walk up the stairs in a 10-story high-rise to the top of the market. But when the market starts going down, you're either in the elevator or sometimes just pushed off the top. And this really made me think of something. I was looking at going to an engineering college right out of high school. And I went to the college, and one of the things they were doing that day when I was checking it out, where they were showing the engineering students a film. This is back in the 70s, of course, when we still had that kind of celluloid thing, clear. You had to project it on a wall, just for those people under 30 that don't remember what film is. But it was a film of bending the wings of a 747 at each end, and they keep jacking each one of them up and each one of them up, another inch, another inch, another inch. These things had gotten about 5 feet higher than the top of the rear tail, to give you an idea. And, of course, that's if you've ever been in a 747, it's a real blast if you can get back in the back and go up the ladder all the way back up the tail, because that's what there is back there, a giant ladder to go back up in there. But I lived where the TWA, grew up where the TWA overhaul base was, and went up there more than a couple of times to check it out and look at. I thought planes were always neat. Growing up on an Air Force base, of course, watching all the jets fly, always interested in that stuff. Anyway, the wings were supposed to break at something like 35 feet up off of a flat and level. And they kept on moving them up another inch, another inch, another inch. And they were designed to go up to 36 or 37 or something. Anyway, they get up to about 42, and they finally snap. Now, is the point that, yes, it was designed and it's stronger than it should be, but to Mark Faber's point, if you just keep pushing it, it is going to bust. Now, the question is, just how catastrophic is it going to be? Would it be better off if you actually snapped at 35, but the wings, basically didn't shatter like a glass vase, or would you be better off that it just didn't crack at all until 42 feet? Of course, you're going to have to really slam that plane around in the wind and maybe come down in an air pocket fairly hard to bend those wings up at the tip, 42 feet off the bottom. It's almost incredible. At the very end of it, they're actually tying the ends and using a come-along kind of thing to pull the wings back into the plane. I've seen it done on the 1960 or the 767 and the new 787s. They've got it on YouTube. But destructive testing is interesting. I'm just wondering why we have to go to destructive testing in the stock market. But there's always those folks that will tell you that it doesn't matter. Too many people are talking about a bubble. And believe it or not, plenty of people were talking about a bubble in 2000, which is what they were talking about on Financial Infotainment today. That it just can't happen. No one knows that there's a bubble going on. We've had a buzzwell in housing was the other excuse I've heard today. And the truth of the matter is you can look at some figures and see whether or not you're in a bubble or not. Right now, the NASDAQ is trading at 25 times earnings. And, of course, everybody says there's no problem. Well, you know, normally past about 15, 16 times earnings, you're pretty up there. 25 times earnings, way up there. And they said, yeah, but it was 250 times earnings at the dot-com bubble. Well, that was because you put in a bunch of companies that didn't make any money at all, and they went to public not making any money at all, and they had no chance of making any money at all. So the question is, do we have stocks like that? Certainly a lot of the IPOs, of which we've got some 20 scheduled coming out this week. The question is whether or not they can actually hold this market up and suck out all that kind of cash with a market that, for the most part, has been going sideways. But do not discount these end-of-the-world guys. And, of course, even Mark Faber's only saying a 20 to 30% pullback. And that would still be a bull market if you look at it in a very, very long term. So what can you say? I know this is exactly the same kind of thing that was going on in 2000 and 2007 with the housing bubble. I'm going to give you two passages here that I really think come close to the heart of the matter. One is one by Jesse Livermore. Markets don't culminate in one grand blaze of glory, and they don't end in a sudden reversal either. They kind of take a while to get up there and hit. But as far as whether or not we've ever hit a high in the market, and we're going to have that kind of pullback, Arthur Schopenhauer, all truth passes through three stages. First, it's ridiculed. Secondly, it is violently opposed. Third, it's being accepted as self-evident. I think we're in that second part right now where it's being violently opposed. We'll be back in just a minute.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the signal box works, visit the front page of TFNN.com.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Dave takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
And as we were talking a little bit about some broad stroke issues in the market, everybody loves to make fun of bears, and one of the problems is that the market is going up about 75% of the time. It goes down about 25% of the time. The problem is it goes down about 3 times faster than it goes up, and if you can get options on the way down, you can actually make some fairly decent money if you're right. And normally, because they decay so fast, very tough to make the same kind of money on the way up unless you have some big moves like you own CMG or Intuitive Surgical. But even those had some pretty high premiums going into earnings over the last week. But anyway, just remember that everybody says that it's been ridiculed. But I'm thinking when I saw what I did today on financial infotainment, it was being violently opposed, and the third part is it being accepted as self-evident. And I'm just looking for a natural retracement in a bull market. And that would not be hard to think that we could pull back 20% in that on a longer-term chart and still be in a bull market. So I think any little tick down is more like an apocalypse. And the rise of the robot rebellion, probably coupled with the apocalypse. What do they call it? The zombie apocalypse. So probably roll all those together, and any pullback on the S&P would be it's the end of the world. Gary Schilling is out this morning Of course, we're going to have a lot of numbers this week. Part of the GDP numbers, if I'm not mistaken, come out this week. He's saying that our GDP numbers are going to come out very close to 1%, more than the 3% that has been advertised. He says it could even be a negative number. This guy is pretty sharp, and of course he has his own housing index now. But I think we could see some real movement by the end of the week. If, one, we have the Fed start to get hawkish, which I think we're going to see at least a few of those comments. We've already heard her talk about part of the markets, especially biotechs and some others sectors being bubbles already, and actually heard some more discussion about bubbles. I forgot to actually say that the old Mr. Doom and Gloom himself was getting savagely attacked on TV for being a bear, which always makes me fun and happy if I'm bearish too. But so it is being violent. When I'm saying it's being violently opposed, it's being savagely opposed at the moment, and normally a good thing if you're a contrarian. Virgin American is filing for an IPO this week. It is probably going to be a little while. Virgin America flies to 22 airports in the United States and Mexico, has a fleet of 53 planes, so really one of the smaller airlines. But, of course, these things are so hot now, why not go to a little IPO? And, again, there's going to be over 20 IPOs. Last week we had about half of them go out. One of them did well, and that's pretty standard for a very, at least a bubbly-looking IPO market to me. So many of those didn't make it out the door. It really looks to me like they're really cramming these things in and hoping, as they all say, throw the spaghetti on the wall and see what sticks. And kind of seeing that right now. I don't know this about Virgin America. I do know when I go through the list of 20 or so IPOs this week, that nothing really jumped out at me as a stock that I wanted to jump all over. A lot of these things are biotechs that are going to have to come back to the well 2 or 3 times for cash. So I don't know why anybody in their right mind would be buying these biotechs now, knowing that they're going to have to sell more stock in the future to gain cash to eventually get to a market. And that's my thought for today. Of course, after the bell tonight, we've got a lot of earnings. Probably the one that'll interest me most is just how bad they try to jam HLF up after the bell. Of course, pretty good evidence that this is a pyramid scheme, albeit legal. In the morning, British Petroleum, UPS, Aetna, Pfizer, Merck, HCA, UBS, DNC, and after hours tomorrow, American Express, Texas Instrument, Newmont Mining, Buffalo Wild Wings.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
And we're back, and we're going to go right to Chris in Wisconsin, since I always spell the Indian name of his town incorrectly, or say it. I will not mention it. How you doing today, Chris?
Hi, this is Chris in Neshota.
Neshota, okay. So what do you want to talk about today?
Sure, I have a question. When you're talking about shorting the market, do you look at the broad market, such as buying puts in the S&P, and if so, how much time value do you purchase?
Normally, I go out if I can, 45 days.
Okay.
That's probably around the sweet spot of risk reward. If you think either a stock or an index is going to break, I don't like to go 1 week unless you're doing something like playing earnings or something. But normally, if you're going to be right in a particular stock, or if you're going to be right in an index, and you try to time it to the minute, at the bottoms, yes, you can see those tests of the bottoms, and they normally only last for a minute. If you wanted to draw a line on a chart, a contact lens is a much better idea of how tops come in. There's a lot of hang time up there at the top, and you can be right, and you can be early, you can be late also, but normally you get enough retraces that if you couldn't short it at the top, you're probably not going to short it after it comes back down a little ways. So if you get the signal, you're always going to be, I tell many people, you're probably going to be 3 days, 3 weeks, or 3 months early when you get the signal. And the question is, are you more than 3 days if you're more than 3 weeks? And a lot of times you'll just have markets like this that just go sideways. And the question is that they'll bore you eventually out. And you'll see a handful of stocks that have huge short interest have earnings and blow people out, both up and down. But it's not uncommon. So the answer I try to go for is normally something like 45 days. So I'd be kind of looking at that at least August, and of course probably more like September's now.
Okay.
I think you want to buy time to be right, because there's so many times when you'll get a stock and you know it's weak. And what happens? There's 20 upgrades to the thing, right? Just suddenly out of thin air. Like, we just need to upgrade it. And, of course, normally that is somebody from one side of the office building calling the other side saying, we need a couple more weeks to distribute this pig. We've got to put some lipstick on it and shove it out the door. And we need, 20 new upgrades for this week. And you don't always get them. And the problem is that if you don't short it, then a lot of times you miss it. And if you're a little early, if you have your patience, you can get it. But that's the conundrum, is whether you want to be that 3 days or 3 weeks early. But normally, if you get a good signal, if you believe in what you have, you're going to be 3 days, 3 weeks early. And the question is, can you make it for the next 3 weeks? And most people don't have that kind of patience. And, they can fall apart in that time. But in my experience, that's kind of my rule. 3 days, 3 weeks, or 3 hours, 3 days, 3 weeks, 3 months, or 3 years. I guess if you took it to its logical conclusion, or 30 years, I guess would be after that. But that's it. But, I'm willing to give a little back because there's so much risk reward down here. I think that any kind of standard retracement could be 200 points to the downside from here. So, and that wouldn't even be anything more than a standard retracement in a long bull market up. And that's why, could we go 20 points higher? The answer is yes. We've got, I'd probably be out if this was a normal month, but since we have the FOMC meetings on Wednesday, I'm expecting very light volume and probably a small pullback into them on Wednesday. And if they go hog wild with their discussions about ramping back up QE and never dropping interest rates again, and the market starts moving up, I'm probably wrong. And I'll probably get out then. But I like the positions I have for the most part right now. They're fairly bloated, and it wouldn't take more than a pinprick, like a balloon, to let a lot of air out incredibly fast. So now the question is, are we going to get it, or are they just going to hold this market up for a long time? And, it's summer. There's light volume. They've got a lot of IPOs that they're trying to cram out the door. Very few of those are making it, Normally, you have a hit ratio of something like 80, 95%, or probably 80 to 90% of IPOs. If they push them out on Monday and say they're going out, they go out. That we had less than 50, I think, last week, and only one successful one. Almost every other one that did make it out the door went lower. But there'll always be the bright, shiny keys in front of the kids, dangling them, going, okay, see the bright, shiny metal. Oh, we got the one loco restaurant, and it did well, and the other one's all kind of blue chunks. But I think you've got a fairly good position to go short this market in a lot of stocks, and I don't think you have much risk reward or risk to the upside when you do have the downside. So, to me, it's always an asymmetrical bet. If I've got a 10-to-1 bet, I can lose 10 times as long as I don't bet the whole thing up front. And I only have to be right 1 out of 10 times to make that cash back. To be right, 9 times for 10 points, though, on the one time it came back, now you got to be right 9 times on the upside. And that's where the whole idea of sitting down and working out a spreadsheet or setting up a Monte Carlo simulator to see how your trading would do based on your risk-reward parameters is a pretty good thing to do. Maybe I'll get my Monte Carlo simulator with, average wins and average payouts. But does that answer your question?
Yes, and then an exit strategy, if you're correct on your assumption of the downturn, as you watch these options, how do you decide to pull the trigger and cash?
Well, normally what I do is and I put this in my newsletter all the time, options are not a way to increase risk. They are a way to reduce risk. So let's say that you had a $1 million portfolio and you wanted to take 1% risk on a stock and you bought the options. You wouldn't buy any more options than you would if you were buying the equity itself, right? So if you were going to trade 100 shares, you buy one option. You don't go buying 10 options because they're cheap. And that's where most people screw up with options. They go, hey, it's only 50 cents or it's only $2 or whatever. I can risk a whole lot more. The idea is to limit your downside and up your upside. And normally when you're buying options, I'd say from people I've talked to in brokerages, probably 90% of people buy way too many options for whatever the size of the portfolio is. So first of all, let's say you were going to lose $2 on a stock, on a $100 stock, and your stop was going to be $2 anyway. Well, you haven't lost any more than you would have had in your stop, and normally they'll still be worth 50 cents or a buck, right? So a lot of times I'll just let the time actually take me out of the trade because it's always that last 2 or 3 days before expiration that someone comes out the news and it falls off the cliff or it goes up $100 or something. So I would say use a whole lot less options and use the time that option gives you and just think of it as if you had a $98 stock that went to 100 and you stopped out, you lost $2, right?
Yes.
To me, that wouldn't be a horrible trade. You limited your risk. You had big upside, even in the equity. But most people decide that suddenly, once they've put an option on, that they should really look at that $2 as being 100% a loss. And I think it's just the opposite way. I'm still playing the equity. I just have limited the downside risk in my play. Does that make sense?
Yes, it does.
Okay, then that way you can play a great deal longer than if you had the actual equity and, the thing goes and pops on you, $15 and you've lost 15% of your full equity position. To me, now most of the time, to tell you the truth, you can't do that. Options are priced so ridiculously high that it's like trying to buy insurance for your house while it's on fire. No one's going to give you any. Like a lot of biotechs right now, some of the implied volatility is over 100% in them. There's no way you're ever going to make a dime on it. So you've got to find something that is better, like a ETF or something else that you can get where that volatility, implied volatility, is probably below like 30 on the IV. You know what that is, right?
Yes.
Okay. So you want to look for low volatility. And, of course, like all the charts I'm going to go through the rest of the show out here, you want to see that you've got some kind of edge. And in my case, my edge is very, highs testing previous highs on very light volume or lows testing lows on previous volume. And then I'll look and see. Then I'll see whether I can actually get an option position. Anyway, thank you very much, Chris. And we're going to go to Sam in Irvine, California. How you doing today, Sam?
Hi, Dave. Thank you very much for taking my call. I love your program, and I'd like to say that I look forward to Friday afternoon to hear your technology report, which is fantastic.
Well, thank you.
My question is about Rite Aid today, or AD. It's got an excessive high volume today, And
Yep.
there's only one news on it, and I want to know who's dumping it, and is it a good... I've used that before. I traded in the past.
Yeah.
Just want to know if I can use it as a swing trade and keep it for a couple of weeks. And
No.
No.
This thing is certainly looks like it's going back to $5.83, which I would love. That gives you the opportunity to get in here at $5.83 since you have a high volume low back there at 39 million shares, right?
Yes.
So your risk reward is going to go up astronomical if you can go into $5.83 with low volume.
I see.
So if you get a close below $5.83 and you come in with like 20 million shares or 15 million shares, right? And it closes back up above 583, or you think it's going to close up above 583, I'd pull the trigger, and then if it still closes in the last couple of minutes at 583 or above, you can hold that stock. This is not really a bad-looking chart out here. Energy has really come off except today on this. I didn't look at the headlines on it, but this is not a bad-looking chart other than the fact that it came off with a lot of energy from the $8.62 high.
Right.
Looks like there's some hit pieces out here on the street.com. Let me see.
Up in Washington.
Oh, okay. You've got a big guy getting out of the market on it. David Einhorn with Greenlight Capital has sold his entire position of the drugstore chain last quarter. Einhorn said Greenlight made the move because Rite Aid sales and profits rose just as the hedge fund had expected, and the stock reacted, reached a fair value. So basically, he had a big elephant getting out of the stock, and he's out, exit stage left, and everybody else is left holding the bag. But that's pretty much it right now. Everybody says, well, if he sold, I probably ought to too. And, this probably looks like it's in a bigger trading range from about that 583. But you have an untested high out here on June 4th, at least in the shorter term. So, yeah. I'd be looking at a play out here if you could get back into that previous low out here at 583. Maybe it gets, I mean, you still have a high volume at $4.73 too. But I think if you have the patience to wait for it to come back in here, you've got darn near 100% trading range out here. If it got to 473, I mean, you're probably looking at a big trading range between that 473 and $8.62.
Having said that, you know now the big elephant left, is 583 still a good place or not anymore?
You don't know. If it comes in there with 20% or half the volume, yes. If it doesn't, if it comes in there with 40 million shares, you're most likely going to come back down to that $4.73.
David, thank you very much.
You bet.
Sure.
Thanks. We'll be back in just a minute.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Catch Tom O'Brien, founder and CEO of TFNN, professional trader and educator. Also a special guest on CNBC, analyzing the commodity markets. Tom will bisect and dissect the markets. The Tom O'Brien Show, next on TFNN.
And we had a question. And you can, probably don't have time to get to me today, but as always, you can call me at 877-927-6648, or you can email me at path@tfnn.com, or post a message in the Tiger's Den. And I do have one, and it says, will Apple ring the bell at the top? Seems like it will go to 100. Certainly looks like it's being drawn there. There is a gap. That gap has existed for a long time, since September 24th of 2012. And if this is pretty much the $700 top, I think within a day or two of that, I put out a special report in the Tech Insider of how ugly all the supplier stocks, like Skyworks Solutions, and the camera folks, and the sensor folks around it looked really horrible. And of course, that's when Apple went from pre-split adjusted 700 to 396 or lower, wasn't it? 390. Anyway, this gap has remained open, 159 million shares. So what we're looking at right now is 37 million shares going back into this high and that gap down. So could it get up to the top? Yeah. I don't think it's doing anything more than filling that gap, and you only have another buck to go. So keep an eye on it. But my guess is you certainly are hitting this high with a whole lot less energy out here. And contrary to the news, which I think a lot of people are ignoring, at least what I'm seeing in Apple, is that the iPhone 5, the larger version of it, the phablet as they're called, the 5.5-inch version of the iPhone's not going to go into production until late September, if not into October. That would probably push delivery off into November, December timeframe. I don't think a slightly newer version of the iPhone 6 with the smaller size is going to make a great deal of a difference. All those are supposed to be going into production next week for sales in late September. And are people buying a quarter ahead of time? I guess you can if you think it. But to me, it looks like they're going to be 1 quarter late in what they're doing. And you could see probably I'm not going to be shorting the stock, but I think that we're very close to seeing a technical signal out here of seeing that gap down just being finally filled. And you can make a fairly nice case that Apple has the ability to see some significant downside in this market. And especially if you look at my power law vector indicator number, we came off with fairly decent heavy volume and almost in half actually split adjusted down to that 5501 low. And you've got some nice gaps out here. I don't think this gap between 75 and 80 is going to remain unfilled over the next year. I think that Apple could continue to have a higher trading range through the fall. But the whole idea that all the accessories like headphones and stuff, everybody's just going to glom onto them, it just hasn't seemed to work out. It hadn't worked out on the iPad, hasn't worked out in a lot of other products. They make one really killer product. A lot of other stuff, some people buy, some people don't. But you're not going to be selling 80, 90 million headphones or 80, 90 million of the wristwatches, I don't think. I think there's going to be those people that will buy them right off the bat. My bet is the conversion rate's going to be rather low on wearables, maybe 10%. Anyway, we'll see you tomorrow. Same bat channel, same bat time. Remember to sell when you can, not when you have to.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.